Welcome to Power Players by Origis, critical thinking to deliver the promise of clean energy. This program brings you leading voices in solar and energy storage and sectors impacting renewables, exploring challenges and solutions for industry growth, the true cost of operating and maintaining power plants, and system asset management considerations. My name is Josh Corbett. I welcome you to this episode hosted by Michael Eyman, Managing Director of Origis Services.
All right, welcome to Power Players. Today on Power Players, we have a guest from the finance industry, David Vence. David Vence is a partner with Antin Infrastructure Partners based out of New York office. The New York office, I think you've got offices all over the world, as I recall. Antin is a leading private equity focused on global infrastructure, so think infrastructure fund. They acquired a majority stake in Origis back in 2021. And since then, David brings a decade of financial market experience to his work building portfolio company value. And we're going to talk a little bit about what that means later, if you don't mind. You also applied a global education focused on statistics, financial math, and most frequently from Stanford, I believe, out of California. David, welcome to the program, and we're really looking forward to having this conversation today.
Thanks, Michael. Thanks for having me today.
Absolutely. So first question first, is it Antin or is it Antin?
Well, it used to be Antin, but now that we're more global in nature and have a large presence in the US and are really a local investor in the North American market, Antin is totally fine.
Antin's fine. Got it. So now I won't feel bad if I mispronounce it throughout this segment. So I appreciate that.
You shouldn't, yeah.
Wonderful. Tell us a little bit about Antin and sort of how, what is Antin and how do you guys approach infrastructure investment?
Yeah, sure. So Antin is a private equity fund focused on infrastructure investments. We have about 30 billion euros of assets under management, and we invest across mostly Western Europe and North America. So our strategy is really to look for investment opportunities that benefit from long-term market trends that pass what we call the Antin Infrastructure test, and that demonstrate a certain degree of complexity and have a really identifiable value creation potential. Maybe in terms of the Antin Infrastructure test, which might sound a little bit cryptic at first, it's really a set of criteria that a business should meet to be considered by us as infrastructure. And so our target companies need to be an essential service to the community, exhibit strong barriers to entry, have some cash flow predictability, and they need to be largely inflation-linked cash flows, and to display some robust downside protection and some insulation from the economic cycle. So this is really our 5-part infra test. Not all renewable companies fit the bill for Antin. In order to meet our investment criteria, look for platforms that have sizable pipelines to build out, some limited merchant exposure in order to get that cash flow predictability, and some downside protection, as I mentioned, as part of the infra test, which can come from either an operating base of assets or from really good visibility over the pipeline through signed PPAs or and secured equipment, etc.
So all of that being the case, like what types of investments does Antin have today globally?
Yeah, sure. So we invest mostly across 4 sectors. Energy and environment is one of them, and as so we have invested in Origis Energy, obviously in North America. We also own another renewable platform in Europe. We have been investing in the renewable sector actually since our first funds, with 2 investments in Fund 1 that were in the space, in solar in particular. We also invest in transportation. We own, for example, a rail business up in Michigan in North America. We invest heavily in telecom. We're one of the first movers in fiber, and looking at fiber as part of the infrastructure asset class. We invested in telecom towers through a previous fund as well. We also make investments in what we call social infrastructure, which is mostly healthcare and education. So a pretty broad spectrum of sectors of investment verticals, And I'd say, but what's even more important to us in terms of defining infrastructure is not necessarily the sector angle, but more those fundamental characteristics that I described. So potentially we could, see different areas beyond those four that I described as being part of infrastructure. For example, we have invested in the food chain with a live salmon logistics business up in Norway and Chile. And we thought that this business really exhibited really strong infrastructure characteristics. So we take a pretty broad view.
Got it. So explain to me a little bit, and anybody listening, frankly, we're sort of talking about infrastructure, like sort of critical, high moat, businesses that serve some sort of broader need. But at the same time, we say private equity. Those historically or traditionally are quite different areas of investment and different return profiles. How do you mix private equity and infrastructure?
Yeah, so it's a very good question. I think the key is really in value creation. It's not because you invest in infrastructure that you're not an active asset manager and that you're not going to create value. And so our goal is to invest in businesses, to your point, that are essential services to communities, et cetera, but to also create a lot of value by improving, growing, transforming the businesses that we invest in. And this is really where the private equity angle in infrastructure comes in. So a big part of the growth and the value creation is enabled by follow-on capital that we make available to our portfolio companies in a way that's always very disciplined and accretive to our returns. Because we do complex deals, we tend to focus from really day one on value creation. That's a big part of our thesis.
Got it. One other side question. What's the view behind you there? It's beautiful. Where are we looking at?
Yeah, that's the view from our New York office. So it's Bryant Park right behind me, and you can see the Empire State Building also right there. But I think the light is pretty strong today, so I'm not sure how well you can see that. But yeah, around 42nd Street, Midtown.
Yeah, it's pretty neat. It's a beautiful view. I wanted to point out it was not a fake backdrop, right?
It is not. Yeah, actually, it's one of our meeting rooms. Yeah.
So you've used the term value a number of times, but I think different people have very different views of what that means. Value is one of those terms that's sort of thrown around in our society as a whole. People talk about family values. People talk about, Christian values. People talk about creating value, and it means very different things in all those contexts. So what does Antin mean when you talk about creating value?
Sure. So, well, we have a very bespoke approach to value creation. So it can mean a lot of different things depending on the portfolio company that we're looking to create value for. What all these have in common is that we think about value in a non-religious way to part of your question, but we think about value in a couple of different ways. I think generally all our businesses have in common that they need to go through the upgrades in corporate infrastructure that all scale-up stories need. And as I mentioned earlier, we do invest in growth stories, so there's always that in common, and we have a team that helps with that. We think that value is really driven by people, both in our portfolio companies and at the Antin level. And so within our portfolio companies, we back management teams that we find exceptional, that we find the best in the market in that specific sector. And then we focus on recruiting additional, senior people, top talents to further strengthen the team. So people is really a key driver of value creation. We help implement value enhancing strategic initiatives, both organic through M&A, the best we can. We upgrade reporting, tracking, etc. We focus a lot on driving valuable customer relationships within our portfolio company. So all that is sort of a toolkit that we can pick from depending on the situation to help build our returns and to help drive growth in a value accretive way. I think one key area currently within our portfolio companies is data. Building a data roadmap has become a critical topic, and maybe I'll spend a minute on that because it's a little bit more recent than some of the more traditional to create value. Yes, sorry.
Yeah, I mean, I'm not used to hearing private equity or infrastructure sort of talk about data as a critical part of value. So how does that drive value from y'all's perspective?
Yeah, sure. So I think it's become really critical to build a data roadmap within portfolio companies. The inclusion of more data can help improve top line, improve efficiency, improve accuracy. But to your point, because it's a little bit newer, I think there are some key pitfalls to avoid when you build a data roadmap. So firstly, I think it's a misconception that building a data roadmap will be disruptive to management. I think can do a lot of proofs of concepts on a more ad hoc basis that can then be integrated into existing processes once it's fully vetted. Secondly, I think building your data roadmap is not solely a systems project. A lot of issues come from when you don't have enough strategic or business-oriented focus on a data roadmap project, and you think it's really just a systems project. And also, I think the last key pitfall that we've seen is thinking that there is no available data, that you don't have enough to work with, and that therefore it's not worth doing this. I think there's always more than you would initially perceive, and in particular with external data. So I think when executed well, incorporating data science into any business can really help quantify the value creation, drive the value creation, dive deeper, for example, into the inner workings of the market, make more unbiased, take more unbiased views than what you would do with more traditional expert discussions, etc. Help manage the business more dynamically, automate a lot of processes. So it's a journey, but it's really worth it, and it's something that, to your point, is gaining momentum, and I think for very good reason. And I think we should not think it's just a buzzword. We should really, go with that flow and give it the right level of strategic attention.
One of the guys that gave me an opportunity when I came out of the military and really started me in solar used to always say, "In God we trust. All others bring data."
Well, I agree with that one.
And if he's listening to this, he knows who he is. Well, so, understanding how you guys look at value, what is the value you see and what is the focus in the U.S. market for Antin? You guys are originally out of France. You have a beautiful New York skyline behind you. You're right here in New York City, the center of finance for the United States. And looking at the U.S. as a market as a whole, the question is why?
Sure. So we opened this New York office about 5 years ago, and we're now deploying about 40%. We're up to 40% of our capital in North America through our three funds. So our flagship funds, our middle market funds, and our next gen fund, which is focused on more an earlier stage or infrastructure in the making, more than proven infrastructure. So I mean, I'm saying this because it shows that that we're big believers in the opportunity for us in the U.S. and for the growth that the U.S. market offers within the infrastructure space. So we continue to see a lot of expansion for us here. In terms of sector, it's really the same as what I mentioned earlier. So committing to investing behind long-term trends, environment, sustainability, aging demographics, and so I think that will that can lead to a pretty broad array of things that we could do in the U.S. And I think the variety of investments that we've done is a good example of where we could go next. We have two fiber companies in the U.S. One is focused on fiber to the home, and the other is focused on selling to carriers and enterprise customers. I think I mentioned our rail business. Origis, obviously, we also have a large district energy platform in the U.S. So having those great platforms that are irreplicable and scaling them up and making them also greener. For example, within district energy, a big topic is electrification rather than using natural gas powered plants to generate steam. is core to our equity story. So I think that is really the driver of our investment philosophy, and we see a tremendous opportunity in all of our markets and in many different U.S. geographies to do that. I think one of the benefits of the U.S. is just how quickly you can gain scale. It's often a less fragmented market to go and address than all the different European countries. So as we grow, as our funds become larger, it's actually a great market to be in to deploy significant capital.
That makes sense. I mean, I have so many questions. I want to pepper you with questions about the rail business and about the fiber business and sort of what, how you view things. I really wonder about sort of when you guys are looking at emerging tech where you are, but we don't have enough time to do everything. So let's focus it down a little bit on the point of Power Players, which is talking a little bit about renewables and solar in particular. Solar is still a maturing industry. It's no secret that there's a lot of ups and downs, but y'all engaging tells me that you see a long-term story here. So why is Antin, hopping onto the solar coaster here in the United States? What's despite the ups and downs, what do you see here as the long-term, direction and promise in this industry?
Yeah, sure. So I mean, we see solar as a huge part of the solution for the green transition, and it's kind of the base solution, and there will be a lot of innovation that will come on top of this, and that will be part of the equity story of solar platforms tomorrow. So what we're seeing, for example, with Origis is, while Origis, the primary equity story is really around building out solar co-located storage.
Yep.
We're increasing our footprint in terms of standalone storage as well. We have agreed to invest significantly in a hydrogen story for Origis, and we're big believers in the fact that Origis will become one of the key players in hydrogen production tomorrow, and that is really better leveraging our very significant solar base. I think also having scale in solar has been increasingly beneficial, because the capital investments required to run a development business have nothing to do today with what they were just a couple of years ago. You need a lot of equity availability to secure PPAs, to secure equipment well ahead of when you would secure equipment in the past. So when we think about our purpose, our mission, which is to enable the green transition through capital, we think that solar is really the way to go, and we won't stop there. I think Origis will continue to diversify its growth in a few targeted adjacent markets. For example, going potentially slightly smaller scale and or going 24/7 in terms of the solutions that they offer to their customers. Continue to be very strong in southeastern bilateral markets, but also continue to expand nationally in new markets. So it's a lot of potential where we think that capital providers that have enough vision, discipline, and who are sufficiently active to invest in that space should be very focused. Core infra players. So when I say core infra players, I mean infra players that have less of an appetite for construction risk, growth, etc., are actually, I think, not the best fitted to take advantage of that growth, because it is a bit of a roller coaster, and it comes with a lot of issue management, and it's a very heavy type of asset management. So it doesn't come with it's not a coupon clipping type of infrastructure. It's one where you really need to be extremely active and bold sometimes, and that's really our DNA. So I think it's a no-brainer for us in terms of where we want to invest our time and energy.
I can't believe, David, you're on this with me, and I run the operations side, Origis Services, and you didn't say anything about investing in operations. I mean, throw me a bone, man.
Because
Come
I was
on.
going to ask you where your
out.
vision was for services. So exactly, yeah, exactly.
I get no
I'm not
help.
the best. You know what? It was intimidating. I'm not in the best place to talk about Origis Services. So so Mike, tell us maybe a bit more about your vision for services.
As they say, I get no respect. It's great, and we're here to talk about Antin and not services, but it's always funny to poke fun at myself at least a little bit. Well, so the market is a bit of a roller coaster, right? I mean, we all talk about that internally who've been through this. Most of us have resumes with companies that are here and then gone, and as this consolidates, but we have had the most recent, sort of tsunami that is affecting the industry is a little thing called the IRA, the Inflation Reduction Act. I'm not sure that it's named appropriately, but the context of it around solar is there was a number of things in there that affected this industry as a whole. Tell me a little bit from an investment perspective. What did the IRA do to the market here in the United States and North America, and what does that mean for Antin?
Sure. So maybe I'll start by saying that, as I alluded to earlier, we've been big believers in the energy transition well before the IRA, and we've been investing in renewables, for a very, very long time. I think opportunities in newly benefiting sectors, particularly hydrogen, RNG, microgrids, are going to be of increasing interest to us because the IRA is de-risking those sectors quite a bit and creating further momentum and hopefully paving the way to more infrastructure-like cash flow profiles within those slightly more nascent sectors. And also, as I mentioned, I think thanks to the IRA, on the back of the IRA, we have invested also significant capital into building out our hydrogen presence through Origis. So that's been a change that's clearly been enabled by the IRA. So growth in adjacent areas, I think, for our existing platforms is a big thing. I think also, well, beyond the IRA, I think the shift that we've seen recently in the renewable market is that you just don't need to be a good developer to succeed. You also need to be very well-rounded and have really good access to capital. And I think to your point around the IRA potentially not being very well named, there's been a lot of issues with costs going up and logistics and panel sourcing, etc. So being able to have the right access to capital and the right supports has been paramount over the past couple of months, also due to the IRA. I think the IRA had also a big impact on financing, positive impact on financing. We saw during the second half of 2022 that while regular financing markets were largely shut for financing, renewable financing continued to be done on competitive terms, in particular with the IRA as a tailwind. And I think pre-IRA, though, the financing market for renewables was very strong for established project financings, but development financings, that market was more in its infancy. And the IRA, I think, really helped bring it out of its infancy, at least slightly, and make it a little bit more mature, which has been important to us as investors in Origis. It's really, I think it also helped lenders reposition some of their balance sheet to where they saw the energy transition going. And banks have been incredibly supportive since the IRA. They've been incredibly supportive of Origis, and we're able to close an initial development financing deal that was actually quite innovative for its time and upsize it to make it one of the largest development facilities for any renewable developer in the US that bundles a lot of different things, letters of credit, equipment financing, etc. The syndicate of banks that we've been able to work with has been incredibly diverse, with North American banks, European banks, Asian lenders, Very large banks are also very supportive of Origis on the tax equity side. So I think the IRA has really helped large developers gain even more momentum and has really refocused the market on this energy transition. So that's been great. And then there is the mechanics and the extension of the tax credits that creates some more work to assess the project economics, etc. But I think all in all, the transition would have happened even without the IRA, but at a slower pace, and I think would not have enabled scale developers like Origis to build out an even larger pipeline more quickly.
Yeah, it makes total sense. I have to though question a little bit. It sometimes seems like, on the one hand, we've got the Infrastructure Reduction Act and the pieces of it that apply to solar, which were clearly intended to stimulate growth of the industry, right? And then but the other side of it, there also is a need then for tax equity. And I think the tax equity market needs to grow from something like 20 billion to like 80 billion. And nobody's sure where that other 60 billion in tax equity is even going to come from. Like, where is that tax appetite and how do you utilize that? In addition, at the same time, we've got the tariff case where, the very thing that we need the most, which is panels coming from China for a lot of very good reasons, have these high tariffs applied or are kept out of the United States completely, depending on the source of the silicon and sort of how these things were built and by whom and what what they represent. So from the solar coaster perspective, it feels a little bit like the government is like slamming on the brake and the gas at the same time. And there's this like sort of governmental kludge of opposing policies. How do you see that? I mean, that's tough to navigate, so how do you see that playing out?
Yeah, it is tough to navigate. I think once again, it's those issues tend to favor the larger developers at the expense of the smaller ones, because you can commit to larger volumes with panel manufacturers. You can have slightly easier, better access to locally sourced panels with more like North American focused manufacturers. On the tax equity side, you can work with the larger usual suspects in terms of getting access to their tax equity financing. I think the issue is probably a little bit more on the down market, and is probably a bit hopefully temporary, because a lot of the measures within the IRA, like transferability, like direct pay for some limited number of cases, will be implemented over the coming months and years, and we're still expecting, as some additional guidance in terms of how this will really be orchestrated and what types of middle agents will need to be part of that transferability process, what roles the banks are going to play, how are new tax equity players going to emerge, at what price are those credits going to be sold. So there are lots of unknowns, but lots of solutions there too. So I believe that while those newer solutions might not change dramatically the way a player like Origis has been doing business, and I think we'll probably continue to rely a lot on our great dialogue with the large tax equity providers structured in the traditional way. I think those new solutions will incredibly help the smaller scale developers and the CNI market, the DG market, and other technologies as well.
So we have inflation. We have at a consumer level, being driven by a whole lot of things: wars, dislocations, disruptions in the supply chain, increased money being sort of flooded into the market, increased demand for some goods and services, decreased supply. And at the same time, we have the Fed raising interest rates, which affects the borrowing rate, which then also affects the expected rate of return required for those investments to occur. Do you see these forces slowing down or affecting working in contravention of the IRA and the intended growth, or do you see a path to navigate that as well financially? I mean, are people still going to invest when the return required because of the cost of their capital has gone up? I think is the basic question.
Yeah, no, I think for sure. I think we're continuing to see a very significant appetite for that market, and also with the with market uncertainty comes certain flight to safety, quality, and and I think the undebatable macro tailwind behind renewables makes it a very safe place to invest into. Also an incredibly high quality cash flow profile, etc. So to your question on appetite, I think it's appetite is going to remain extremely high. Cost of debt financing will be a factor as it mechanically impacts project economics, as you have to factor in the revised rates in the market. That said, I think from a margin standpoint, renewable financing deals continue to be done on pretty competitive terms compared to other sectors. So I mean, yes, there's uncertainty in the market, but I think it is something that the strong players will navigate very well.
It's interesting. I think what I'm hearing from you is, for the larger players that are established, that have good financing partners like Antin and, networks of relationships with banks and a history of deploying capital and, successfully, that they'll be able to do this. But for the smaller companies, this is going to be a challenging time. Access to capital may be squeezed. Is that the takeaway?
I mean, it could be. I think the access to equity, even for the smaller players, might still be fine. There is a pretty deep middle markets infrastructure sector in the U.S. that will continue to invest in less scaled players. I think it's more on the operational side that's the struggle might come. So having access to well-priced equipment, the bargaining power, just because of the supply and demand dynamics, is going to be easier for the larger players than for the smaller players. And I think also there's while the up market is not so fragmented in renewables, there are a lot of smaller scale developers, a lot of entrepreneurs who started their business, etc. So I don't think there will be space for all of these players to really scale up, and there might be some more consolidation happening. But that said, I think by and large, access to capital will probably be not as difficult in this sector, whatever your scale, versus other sectors in the market.
Got it. I think those are some good takeaways from the folks listening. We want to always try to leave folks with things that they can actually use, out of this program. So that's helpful. Thank you. Let's talk a little bit about a more controversial topic. I see in the news today, in the corporate world, we talk ESG quite a lot, and that gets connected to this idea of creating value, as well as sort of, social justice and a bunch of other areas. I think there's another part of the conversation that looks at ESG as this sort of self-inflicted wound that the government pushes upon companies that distracts them from their core mission. How do you guys view ESG? How do you view this debate? And when you look at companies, within the context of ESG programs, how do you view that as part of the value that you deliver and your investments deliver?
Yeah.
And why?
So, sure. So I'd say we really integrate ESG throughout the investment cycle as a means both to mitigate risk and also create value. So we're definitely on that side.
How does it mitigate risk? That
Yeah, I'll get to that a bit more, but I think actually beyond mitigating risk, and I'll explain a bit more, and enhancing returns, our emphasis on ESG is also driven by other factors like regulatory compliance, corporate financing, fiduciary duty. So there are lots of stakeholder expectations in terms of the investors in our funds. So there's a lot at stake for us within ESG. And to give you a very concrete example around how ESG is a risk mitigant. So thinking about Origis and the renewable space, I think ESG is really a way, frankly, not to lose your license to operate in the future. And as an example of that, we've had a very disciplined approach to panel sourcing, tracking where our panels came from, etc. And I think had we not done that, we would have been at a much higher risk of seeing some of our equipment sourcing frozen through the import bans that the US went through recently, and as a consequence of that, potentially deteriorate some of our customer relationships. And thanks to our, I think, really good ESG practices and good tracking of where we source things, we actually benefited from that situation, whereby it reinforced vis-a-vis our customers our ability to execute, to deliver, to de-risk their investment, and that has incredible value for our off-takers, for our customers. So ESG is really a way to mitigate risk. I think then, how do we go about implementing those ESG roadmaps? And it's a pretty broad. I'll keep it high level because it's pretty broad. Three very different words within ESG. So it's a broad topic. But what we do is post-closing, we conduct some materiality assessments, and we try to prioritize what are the material ESG issues for a portfolio company that we need to focus on. We try to define KPIs to really track those issues and set targets. And again, KPIs need to be set in a useful way. So it's not KPIs for KPIs, but it's KPIs to be helpful and really drive the business. We create an action plan based on those on that assessments. And so as an example of that, in addition to our direct investments in decarbonization and energy independence like Origis, all of our portfolio companies, including Origis, have specific decarbonization goals for themselves. So at the end of the day, ESG is a best practice, an ethical way of conducting business, and also a big risk mitigant in terms of your ability to operate, to attract talents. For example, as we some of our counterparts in some of our businesses, as for example universities, and it's pretty awesome to see how students who enroll in universities have among their selection criteria ranking really, really high the sustainability goals of their campuses, meaning access to cleaner power, cleaner heating, proper wastewater treatments, sustainable food sourcing. So I think at all levels and even more so within the newer generation, ESG is absolutely critical.
Yeah, it is interesting. We do see, employees, particularly the younger generation of employees, they really, the values that they are going to take part in day to day as part of their job matter to them, right?
Yeah.
And I can agree with that. I mean, I'm here in solar out of a desire to continue to serve in some way, and I think what I hear is Antin and David Vence are also engaged in renewables as in part because of that, because of a values-based view on where to put money, and I think people can appreciate that, and we need more of that in the industry. So, I think from here, I think the question is what's next for Antin? Like, what are the next things you're looking for? What do you see on the horizon in the industry and for your investments as a whole?
Sure. I mean, what's next is, I think, really to continue to be an enabler of the green transition and doing our part by investing capital in that transition. We think the pressure coming from climate change consequences are going to is going to increase and to only go one way. And I think there's a very broad array of areas that will need further support in order to operate that transition seamlessly. And for example, there are changing requirements for transmission, for storage. There's a big opportunity for innovation that we're just starting to see, and innovation can be the application of new technologies to existing assets, like the focus that some oil and gas companies have been having on carbon capture, or it can be just next generation ways of doing certain things, like beneficial reuse of waste, etc. So what's next is to continue to focus on the right things, be disciplined, and these are long-term investments. So to your question on the longer term, I think this is what we're doing now is really shaping what the world should look like in 30 years from now.
Yeah. Well, so out of all we've talked about today, we're coming up close to the end of this segment. Final thoughts. What do you want to leave folks with out of this?
Sure. So, well, I'd say a lot of what we've been, talking about today are not necessarily themes that sound new. I think but I think what I want people to leave people with is the idea that it's not because we talk a lot about things that things are getting done. And I think continuing to focus on the right things, continuing to translate what sometimes seems to be, nice words on a blank sheet of paper into actions, into making capital available for the right purpose is critical if we want to actually enact change and not just write what the change should be. So I guess that's what I'd like to leave people with, and we strive to we try to do our best to be part of a better future. And so tomorrow will tell us if we were right, but hopefully we are.
Yeah, we'll see, I think. But I think most people appreciate companies, investment, infrastructure, private equity that's really looking to put capital at risk to try to make the future that we're all hoping for. And Antin is here in the United States doing great things, and I really appreciate your time today. You guys are power investors, and you're definitely a power player, and thank you.
Thanks very much, Michael.
Find summary thoughts on this topic and more insights into operating your clean energy assets at origisservices.com. Thank you for listening to this episode of Power Players by Origis, critical thinking to deliver the clean energy promise.